When you buy a stock, you're purchasing a small ownership stake in a company, like Apple, Amazon, or Coca-Cola. That means you benefit when the company performs well, because the value of your shares tends to rise. On the flip side, if the company struggles, your investment can lose value. Stocks are known for delivering some of the highest long-term returns among all asset classes, which is why they're a cornerstone of most investment portfolios. They're also easy to buy and sell through brokerage accounts and can pay you regular income through dividends, your share of the company's profits. However, prices can fluctuate wildly in response to news, market trends, or economic shifts. You're also exposed to company-specific risks, like poor management or declining sales. Plus, emotions like fear and greed often lead investors to buy high and sell low, hurting their long-term performance. Bonds, often considered the grown-ups of the investment world. When you buy a bond, you're essentially lending money to a government, municipality, or corporation. In exchange, they agree to pay you regular interest, called the coupon, and return your original investment or principal at a fixed maturity date. Bonds are seen as more predictable and less volatile than stocks, making them a popular choice for conservative investors. One of the biggest advantages of bonds is stability. They typically provide steady income through interest payments and are often used to balance out riskier investments in a diversified portfolio. Government bonds, especially those from stable countries, are considered among the safest investments. However, their returns are usually lower than stocks and they're sensitive to interest rate changes. When rates rise, bond prices often fall. Some bonds, like high-yield or junk bonds, also carry higher risk of default. This means not all bonds are created equal, and it's important to know what you're buying. A mutual fund is like a financial smoothie, blending together dozens, sometimes hundreds of different investments such as stocks, bonds, or other assets into one convenient portfolio. Instead of picking individual companies or bonds yourself, you pool your money with other investors, and a professional fund manager handles all the buying, selling, and decision-making on your behalf. The main goal of a mutual fund is diversification, which helps reduce risk. If one investment in the fund performs poorly, the others may help balance it out. This makes mutual funds especially appealing to beginners who want a simple way to invest across a broad range of assets without needing to research every single option. However, they often come with management fees that can eat into your returns over time. You also don't have control over the individual investments within the fund, and actively managed mutual funds can sometimes underperform the broader market, especially after fees are taken into account. Index funds and ETFs are two of the most popular investment options for passive long-term investors. An index fund is a type of mutual fund that mirrors the performance of a specific market index, like the S&P 500. Rather than trying to beat the market, it simply matches it. This means fewer trades, lower costs, and consistent returns over time. An ETF, or exchange-traded fund, often tracks the same indexes as index funds but trades on the stock exchange like a regular stock. You can buy and sell an ETF throughout the trading day, making it more flexible than a traditional mutual fund. What makes both of these so appealing? Simplicity, low fees, and built-in diversification. With one purchase, you're investing in hundreds of companies at once. It's a straightforward way to spread out risk and capture the overall growth of the market. However, if the overall market drops, your investment will too. And while most ETFs are broad-based, some are hyper-focused on specific sectors or trends and can carry higher risk. When you invest in real estate, you're typically buying physical property, whether it's a single-family home, a multi-unit apartment building, a storefront, or even a short-term vacation rental. The goal? To generate income and grow your investment. There are two main ways to make money in real estate: through cash flow, which comes from rent paid by tenants, and through appreciation, which is the increase in property value over time. In strong markets, both can provide solid returns. There are also some great tax benefits, including deductions for mortgage interest, depreciation, and operating expenses. And unlike stocks or bonds, real estate is a tangible asset, something you can see, touch, and improve. However, buying property usually requires a large upfront investment and ongoing maintenance. Tenants can be unreliable, repairs can be expensive, and selling a property isn't always quick or easy. Want to invest in real estate without the stress of buying, managing, or fixing up a property? That's where REITs, or real estate investment trusts, come in. REITs are companies that own, operate, or finance income-generating real estate. This can include everything from apartment buildings and shopping centers to office spaces, warehouses, hospitals, and even data centers. When you buy shares in a REIT, you're essentially buying a slice of a professionally managed real estate portfolio. What makes REITs especially appealing is their accessibility. You can invest in them just like you would with stocks through a brokerage account. And many pay out high dividends since they're legally required to return at least 90% of their taxable income to shareholders. They also offer built-in diversification, giving you exposure to multiple properties or property types without needing to manage anything yourself. However, their value can drop when interest rates rise since higher rates make their dividends less attractive. Cryptocurrencies like Bitcoin, Ethereum, and Solana are digital assets built on blockchain technology, a decentralized system that records and verifies transactions across a network of computers. Unlike traditional currencies, they aren't controlled by any government or central bank. Crypto has captured global attention because of its massive potential upside. Some early adopters saw life-changing returns, and many believe blockchain has the power to revolutionize industries. It's also accessible 24/7, and you can trade from anywhere with an internet connection. But with that potential comes serious risk. Crypto markets are known for extreme volatility. Prices can swing dramatically in hours or even minutes. There's also regulatory uncertainty. Different countries treat cryptocurrencies in very different ways, and future regulations could impact the market significantly. Also, lose your digital wallet password or private keys, and your crypto could be gone forever. There are no customer service numbers to call or recovery options. Commodities are physical, raw materials that are bought and sold in global markets. Think gold, silver, oil, wheat, natural gas, or even coffee beans. These are the building blocks of the global economy, and their prices are influenced by supply and demand, geopolitical events, and natural disasters. Investors often turn to commodities as a way to hedge against inflation or protect their portfolios during times of economic uncertainty. For example, when inflation rises, the value of paper money tends to decline. But commodities like gold often hold or increase their value. They also help diversify a portfolio, since their performance doesn't always move in sync with stocks or bonds. But commodities are not beginner-friendly. They can be highly volatile. A drought, a war, or a sudden policy change can cause prices to spike or plummet. Predicting commodity prices requires an understanding of global trends, production levels, and complex trading instruments like futures contracts. Additionally, direct investment in commodities often involves more than just clicking buy. It may require trading on specialized exchanges or through funds designed to track these assets. Options and other derivatives are advanced financial instruments that allow investors to speculate or hedge based on the future price of an asset, usually a stock, but also things like commodities, currencies, or indexes. With options, you're not buying the asset itself, you're buying the right, but not the obligation, to buy or sell it at a specific price within a certain time frame. There are two main types. A call option means you believe the price will go up. A put option means you think the price will go down. Options can offer very high returns with a small upfront investment because of their built-in leverage. That makes them attractive to investors who want to profit from short-term movements without owning the actual asset. They're also used to hedge against losses, for example, protecting a stock portfolio during a downturn. But the risk is just as high. Options are complex, time-sensitive, and can expire worthless. If your prediction is wrong or you mistime it, you can lose more than your initial investment. Certificates of deposit, or CDs, are one of the safest and simplest investment options out there, ideal for people who want guaranteed returns with little to no risk. Here's how it works. You deposit a set amount of money into a CD at a bank or credit union for a fixed period of time, typically anywhere from 6 months to 5 years. In return, the bank pays you a fixed interest rate. When the term ends, you get your original money back plus interest. CDs are FDIC insured, meaning your money is protected even if the bank fails. They're great for short-term savings goals or for parking funds you want to keep safe, but still earning a little interest. However, the trade-off for this safety is that returns are relatively low. Their returns are generally lower than riskier assets like stocks, and their rates may be higher or lower than a high-yield savings account, depending on the market and the CD's term length. Plus, if you withdraw your money before the CD matures, you'll face early withdrawal penalties, which can reduce or eliminate your interest earnings. Private equity and venture capital are types of investments that involve putting money into private companies, those that aren't traded on public stock exchanges. These are high-stakes, high-reward opportunities. Private equity typically involves investing in established businesses that need capital for expansion, restructuring, or even complete turnaround. The goal is to improve the company's performance and eventually sell it for a profit, either through a sale, merger, or IPO. Venture capital, on the other hand, focuses on early-stage startups with high growth potential. These companies are often in tech, biotech, or other innovative industries. They might not be profitable yet, but investors are betting they will be big in the future. The potential upside is massive. You could be investing in the next Amazon, Google, or Uber, but the risks are equally large. Many startups fail, and private equity deals often require large sums of money tied up for years before any returns are realized. These investments are usually restricted to accredited investors, those with high income or net worth, due to the high risk and long time horizon. Art and collectibles fall under the category of alternative assets, investments that go beyond stocks, bonds, or real estate. These can include fine art, rare sneakers, vintage watches, comic books, Pokemon cards, and other culturally or historically significant items. What makes them valuable? A mix of scarcity, demand, cultural relevance, and the prestige of ownership. Unlike publicly traded investments, the value of collectibles is often driven by emotion and exclusivity. That makes them especially appealing to collectors or enthusiasts who understand the market. But investing in collectibles also comes with serious challenges. These items are typically hard to sell quickly. Prices are subjective, and finding the right buyer can take time. Plus, it often requires deep, specialized knowledge to know what's truly valuable and what's just hype.